Mike, Isaac, Seth, welcome.
Peter.
Yeah, good to talk to you guys, and very excited to have this update conversation about what's happening in the Bronx. We haven't had one of these in a number of weeks. I think this is, kind of a Q4 wrap up. So we were just spitballing some of the things that we're noticing in the market right now, and yeah, one of them in terms of getting deals done right now, especially in the Bronx, is about the relationships you have with buyers. And one of the questions that sellers will always ask us is, well, how do you know this buyer, or what's their reputation? In this current market environment, that type of information, I think, is much more important right now. Mike, can you talk a little bit about that?
Yeah, I think it's a good point to kick off with. I think that buyers more than ever are more important, obviously, because representing sellers a lot, you want to be able to bring a slew of buyers to the table that have a high probability of closing. As we all know, it's a turbulent environment out there, so bringing somebody to the table that can actually secure financing and close is extremely important. So buyers all over the spectrum, I think there's different tranches of buyers and their strengths. And I think that buyers are looking for either cash flow or basis.
Mm-hmm.
So.
But I think if you look at this right now, it's the relationship that you have with a buyer, because we're just in a phase in the market where trust is much more important, right? Like, someone's going to do what they say they're going to do.
Yeah, and I think that plays into us delivering somebody, bringing them to the table that has a high level of certainty. We have a high level of certainty that they're actually going to close. Mm-hmm. I think that relationship plays into the comfortability of us saying, hey, Mr. Seller, this is the buyer that we want to move forward with because of X, Y, and Z reason.
Mm-hmm. Right. Seth, do you have anything to add to this point?
I think just reiterating what Mike was saying, execution is important. It's ridiculously difficult to execute on, you got to go through due diligence. The diligence list that the buyers are giving us now when they start negotiating a contract, I haven't seen a list like this in several years. It used to be like rent roll, DHCRs, and hey, like, try to ask for a fuel bill. If you get it, great. If not, no problem. Now it's local law this, local law that. Make sure you give me your elevator inspections, your boiler inspections. So having the relationships with the buyers who are able to perform, what their diligence process looks like. Do they do their DHCR review themselves? Do they hire an attorney? Which attorney do they like to hire? Knowing these things, like these little nuances of the deal, are very important. It's not like, just go bring me a buyer. It's like, no, we got to talk about this. Like, what's it going to look like? Foreshadowing and educating the sellers on what the process is like to get from owning the building to closing. It's very important.
Yeah. Well, it's almost like it's flip-flopped, whereas 2 years ago or 2.5 years ago, if you have a buyer and it was their first purchase and maybe they were still feeling their way through the market, and that's why they were at the top of the heap and why you were selecting them as the buyer, it was almost better if, in a sales process, you didn't know who the buyer was, because that almost meant that the seller was getting a good deal. And now where we are, it's not worth the risk for the seller to go down the road with someone who's untested, unless there's really some specific circumstances that would make that true.
Yeah, it could look like, okay, you're getting an extra 1%, 2%, or 3% higher than the next bidder, but remember, these buyers have to go through the lending environment to get their financing lined up, and the lending environment is more difficult than passing our test of the sniff test of, hey, can you close?
What are the biggest things that you're seeing on the lending side that are more difficult than they were a year ago?
Putting money in reserves, especially if there's any retail component. Asking for the arrears reports. The lenders, from before they sign the contract, the buyers need arrears reports every month for the past 3 or 4 months to get the lending lined up. Um, it's difficult, but I mean, you can get very, very attractive financing. So if you can borrow at 3% right now, if it's fully rent stabilized and the rents are low, you could actually qualify for like some type of affordable financing from Fannie or Freddie for 10 years, a little bit of interest only. So those programs they're out there.
Yeah. And how are you seeing that come up? Those programs, Isaac, if we look at the pricing on those programs, where you're able to get loans in the threes, and with cap rates where you are. First of all, kind of on an average basis, where are we seeing cap rates? And talk a little bit about the spread between cap rates and your interest rates, and where you see that as an opportunity.
Yeah, so I think, and we're seeing this on a couple of our on a couple of our larger deals that we've listed both uptown and in the Bronx. These larger buildings, they do drive a premium. They don't come up for sale very often, and they're generational assets. And so, if you look at the cap rates there, they're going to be a little bit of an outlier. Some of them are barely pushing 5. Some of them are closer to 5.5. But if you're borrowing, as you know, one of our deals uptown will indicate when it closes, you know, the spread there, you're able to achieve close to a 10% or north of a 10% cash on cash, which regardless of really, you know, other market factors, that's incredible. And just, you know, broad strokes, some of the smaller buildings in the Bronx, a lot of those are having to trade at a little bit of a higher cap. They trade more often, and that's more of a cash flow driven buyer. But again, I've had this conversation, you know, all of last week with some of the younger guys coming into the market. The cash on cash that they're going to be able to achieve is going to be tremendous as well, just because of, you know, where you can borrow, whether you're mixing in IO or not. You're going to have very strong day one cash flow.
Yeah. So as long as you keep your collections within range, these buildings are going to be cash flowing. And look, we all know that's and this is going back to June of 2019, when the laws changed and when the market basically shifted from being a market where you buy for appreciation to one where you buy for cash flow. And coronavirus has just, and you know, the kind of all the economic things that are surrounding that has just accelerated that trend. And so for us to be recording this and talking about buying buildings in the Bronx where you're going to be getting 8, 9, 10, you know, some type of double digit cash on cash, it just seems highly unusual. I don't think I've seen economics like that. You know, in my career in New York City, I've seen it twice. One is the year of 2009, and then you saw it a little bit in 2002. So, you know, these are kind of like this is like the 10-year flood event. You know, where you're seeing this type of pricing. I think there's a caveat to this type of pricing, or what you should be seeing, which is the cost of regulations. And when you look at broker setups, a lot of them in New York don't have anything for a line item that you would typically call general and administrative, right? The general and administration, or G&A, or whatever, right? And there are so many different types of regulations and new ones that are being foisted on owners, and it's very hard to predict what these costs are, you know, what they may be on an annual basis. So Mike, how are you navigating around this expense? You know, really from an advising the buyer standpoint, and also how are you working it into pricing?
Yeah, so I think it's obviously something that comes up in the conversation every single time. You know, it is the elephant in the room per se. You know, if you're talking about New York City, you're talking about the assumption of political risk that comes with it. You know, and you know the way that we really look at it is when you look at our setups, and we've been told by buyers multiple times that our setups are our expenses on our setups are beefed up, and we like to do that because there's no secrets anymore in this market. The buildings cost a lot of money to run, and that's just what it is, right? So, you know, I think when you're projecting that on a buyer, it really comes down to, I alluded to this before, there's tranches of buyers, right? And every buyer is going to assume and think about how that political risk factors into their bottom line differently. So everybody knows it's out there. everybody who's putting money into the market is quantifying that political risk in some way, shape, and form. Do I coach them on that? No, because buyer A might look at it differently, and they're long on the city and they're going to be here for 10 years, 15 years, and it's going to the kids. So guess what? The politics, it might only last for 5 years, right? So, buyer B, they might be looking at a little bit of a shorter term horizon, but at the end of the day, it's there. We underwrite aggressively on our expenses to, navigate any, backlash on pricing or negotiating. But everybody has their own MO when they're underwriting these deals, and it's no secret.
Right. Right. And look, and I think it's all about being more realistic with pricing because, with what the expenses are, because that's how you gain the credibility. But when we talk about the regulations, it all gets down to, the really specific local knowledge. Right. And Seth, do you have any examples of how that really comes to play in any recent transactions or in deals that you've seen of where just knowing how the regulations have changed of how you operate buildings or things that are required where do you have any example of just how important knowing what's really happening on the ground is?
I have a great example of that. Most recently, a client sold a building with an elevator in it, and I was talking to this person, and it's like, okay, like, why are you selling? And one of the reasons that she said she was selling was because one of the new local laws was to upgrade the elevator locks in the elevators, and her elevators were so old that they couldn't actually handle the upgrade, so she would have to redo the entire elevator.
Wow.
And she had multiple elevators in the building. So this was like hundreds of thousands of dollars worth of an expense. And she's like, I'm not doing that. And that was, and I think you're going to see more and more of this for people that are, of retirement age and have just been doing this for a long time. I think it's getting more and more difficult. And I think you're going to see people just decide to move on and do something else.
Yeah. So in that example, number one, you really had to know what was going on because you're talking about something very similar or very simple, I should say, where it's an elevator lock where if you didn't know all the intricacies of how that building system worked and how the new regulations may or may not kind of seamlessly fit into that building system, that this would go from a $10,000 fix to something that could be hundreds of thousands of dollars, and that's obviously a big impact. But I think the bigger theme that is coming out of this that we're starting to see is that there are these singular events that are almost like the straw that broke the camel's back. In that we've had a really tumultuous couple of years. In New York multifamily, specifically with stabilized product, and that so how do what's the culmination of this? Like, how is that creating sellers in the market right now? I guess Isaac, you could take it, and then maybe Mike and Seth, you can jump in. How are sellers being created right now?
I think, kind of just to piggyback first off of what Seth was saying with regards to some of the new maintenance requirements, I think that is going to be, the newest batch of sellers, so to speak, whether it's the elevator lock systems or the new sprinkler legislation. I had a conversation yesterday with a sizable landlord up in the Bronx who said there are some buildings that he has that A, just aren't piped for it, or B, it'll just, in general be too big of a project to take on for a building, of a certain size. So I think that's going to create sellers. And then I think, back to what we talked about in September, where it was, people that were hanging on after the rent laws, they've hung on thus far throughout COVID. And like Seth was saying, they don't want to sell at the bottom. It's not a good feeling, whether it's a vaccine or some trend changes in terms of how, the virus is going throughout the country or just in New York, seeing a glimmer of hope, starting to see that, there are a lot of, investors who are starting to poke their heads up and transact. I think that's going to create a lot of sellers as well. And I think there's going to be a ton of opportunity as well.
Mm-hmm. Yeah, I think to piggyback off of Isaac, a lot of the people who we see moving around money is these larger clients who are reallocating capital into different markets, whether it be in a market outside of New York City altogether, in garden style apartments in Florida and Texas, which I'm sure a lot of people have been hearing as a common theme, or net lease. And not only that, there's a lot of people who don't want to get out of New York City. They're long on the city. They like the city. They're here. It's home. So buying south of 96th Street at, a good basis with decent cash flow in a really, really clean building with a heavy component of free market, to sell 3 Bronx buildings and buy one really big elevator building south of 96th Street in Manhattan. We've been trying to connect on this with a handful of clients for the past 5-6 years, and it's been, extremely difficult, with where pricing was. But right now, it's a lot of, again, these larger clients are looking at it extremely opportunistically for that transition.
Yeah, well,
quality of asset.
When you bring that up, if you look at the top bidders of, the last 3 deals that we put under contract in Manhattan, in that, top 1, 2, 3 bidders on all of them has been owners from the Bronx who are either in an exchange from selling their Bronx property, or they had refinanced their Bronx property and they said, this is an opportunity to upgrade the quality of my asset or the location. So,
yep.
Seth, how are you seeing this play out in terms of the additional regulations, and also just where we are? We're at the back, at the end of the fourth quarter. We're entering into 2021. Do you have a sense of how is that whole mix of the time and also what's happening in the market going to play into who are the sellers in the first half of 2021?
I think you're starting to see, COVID, it's taken about 6 months for people to adjust their expectations from COVID, buyers and sellers. And I think you're really, over the last 30 or 45 days, starting to see, the curve sort of bottom out, and, we're starting to meet people in the middle now. Buyers and sellers are starting to make deals. The lenders, I think, are going to start to participate a little bit more. You don't see this yet because none of that data is out yet. But everything that we're hearing now is that the lenders are starting to see the writing on their wall, and they're going to start to make some deals here. I think
make some deals. Can you expand on that when you say make some deals?
Sell the notes at a discount to some of their existing clients. If the building's worth $10 million and the note is worth, $9.5 million, working out an agreement with the purchaser and the seller to just, now you have like 3 people involved in the deal. I think that's going to start to happen where, the lenders want out. There's nothing in it for the seller. The seller could kind of hold up the lender and the buyer. Everyone wants out. Everyone wants to just move things.
Yeah. So you're almost saying that the lenders have moved from a we're not gonna do anything. Maybe we'll just give you some forbearance right now on your loan payments, to, okay, we're acknowledging that the pricing in the market has changed, and we will be a participant at the table of trying to make a deal.
Yeah, look, you've had almost an entire year's worth of data and transaction history now in 2020 of where the market is. And if we had this conversation 90 or 120 days ago, I would have told you that there's not enough data out there. The appraisals are all over the place. No one knows what the real values are. We're in a pricing discovery phase. And I think we're well past that now. We have a really good sense of what the values are. I think people are starting to understand that. All people in the business, lenders, appraisers, buyers, sellers. And I think that's gearing up to be a very big 2021. I think you're going to see, the first quarter continue at this pace. I think a lot of people are going to be looking at the vaccine as, a sign of relief. And just more clarity. And I think, that second quarter of next year, I think it's going to be very, very active.
You sound like you're saying that the fact that we may be turning a corner, the vaccine's coming out, that it's almost this is almost giving sellers who are on the fence a license to do something, or it's an excuse to, okay, I can now finally, where maybe they would have held back and said, look, I'm at the bottom of the lockdown, I'm at the bottom of the coronavirus, so I'm not going to sell now. But as they come out, they've wanted to, and now as they come out and things start to improve slightly, they're going to say, okay, this is a time where at least I feel all right about myself about doing it.
Yeah, it doesn't feel that great necessarily to sell right now, but if you have a vaccine, if you don't have 7 vacant apartments in your building when you go to sell it, if there's only 1 or 2, that feels a lot better. In theory, you should get a better price for that. It's an excuse to sell for the same reason why, people candidly have an excuse to sell now with COVID.
Yeah.
And I think it's equally as important to talk about that on the buy side. I mean, you alluded to it, but buyers are on some of the deals that that we have out there that are priced on, I would say the upper end of where the market is. We're touring buildings like crazy. There's a lot of bids. There's a lot of activity. I think the delta between where offers are coming in, like that spread is the biggest I've seen it as to, I'll have an offer at 100 a door, and then I'll have an offer at $125,000 a unit. And people are looking at deals through completely different lenses. Some of it doesn't make any sense, but the activity in Q4, and all of us can say this, I mean, it feels like normal.
Right.
To a certain extent. It feels like somewhat like normal from market activity.
Yeah, you're back.
Deals, touring buildings, getting offers. It's good.
Your activity level is highest. Well, one of the leading indicators that I think I'd like to hear more about it, we'll wrap up after this, is, Mike, we were talking about when the pandemic hit in, April, May, June, it was almost impossible to raise money for a New York City deal. How are you seeing that change now as we're basically right at the tail end of the fourth quarter?
Yeah, I think on the syndication side, buyer appetite is definitely adjusted to the risk of New York City. The past 5 months, a lot of the people who we saw, touching their toe in the water, being the first people who were really starting to bid on deals when it was a little quieter, like 5-6 months ago, those were the longer term family offices. Now, a lot of our bidders are these guys who we've transacted with over the past 5 years, because it was such a syndicated market, over the past 5 years, when there was that value add strategy, obviously, that went by the wayside in 2019. But, if you look at where debt is and you look at where your cap rate is today, that spread, there's investors out there that want to put their money in New York City for a double-digit cash-on-cash return. I can guarantee that, right? So it just depends on the investment horizon of, the appetite for your investors. But it's out there, and a lot of deals that have been done in the Bronx and are going to get done in the Bronx, our top bidders are people who are syndicating money. It might be, family office syndication, but they're still raising money.
Yeah, well, I'm just calling that as a shift. Is that's something that's occurring today that wasn't happening 6 months ago, and to us, that's a leading indicator of what's to come. And I think it points to what Seth just said, which is as you start getting into 2021, the number of transactions are going to rise because you have a need from long-term owners, or really a desire from long-term owners to dispose of the assets. And now buyers are starting to look a little more opportunistically. They're at least wrapping their heads around what the obstacles are in front of them, and they're buying with a very long-term outlook. But as you said, if you have in the high single digits cash on cash returns, you can raise money on that, and people are willing to do it.
Absolutely.
All right, guys. Mike, Seth, Isaac, thanks for this Q4 wrap up of what's happening in the Bronx.
Let's have a good 2021.
All right. Talk to you guys later.